Forget the 60 to 40 rule when trying to make an investing portfolio. Vanguard says to go 70% in bonds in today's market. Although that seems a little high to me, and I personally would never put 70% of my money unless I was a billionaire and I just wanted to make 4% to 3% returns. The outcome of that is, or the likelihood of that is going to be very, very little, very close to none. So I think I have to have a little bit more risk in my portfolio, but I do understand why they're saying it. If you take a look at this S&P 500 chart, the S&P is up at all-time highs and it keeps breaking all-time highs almost every single month. Now, Vanguard recently took out an article recommending investors to go highly towards bonds with a 70% allocation due to the high price of the S&P 500, and it makes kind of sense because there are a few ETFs out there like the TOT and the Vanguard Total Market Bond ETF that I'm going to show you in a few that give you about a 3.7 to 4.2 yield, which is not terrible when you want to have your money there making some money for you if you can't find any opportunities in the stock market since it's being so high valued at the moment. For example, the 10-year US Treasury yield is currently at 4.2%, which is a very good return when you think about it with something quote unquote as safe as bonds, and is a good way to diversify your portfolio. But again, 70% I think is just ridiculous. However, that's just my own personal opinion. I think Vanguard knows a lot more than I do. Now, there's no exact correlation, but usually when interest rates start dropping, bonds start going up, and mortgage rates have been declining little by little according to Zillow. The current 30-year mortgage rate is about 6.12%. Earlier in the year, we were about 6.5, 6.7, and the 15-year fix is currently at 5.34%. Now, as you can see on this chart by Vanguard, there's a low correlation between bond yields and central bank rates. So this isn't an exact science that if the rates drop, bonds are going to go up. But if we take a look at something like the TOT, we take a look at the 10-year chart or even the max chart, we can go ahead and see that this has been beating down a lot. They currently have a yield of 4.31%. And due to the market being so expensive, a lot of people are looking towards this to make a good income, not only in appreciation of the ETF, which is not going to grow by a lot, but as you can see, there is some room for it to go to all-time highs. Will it go all the way up to here? Highly unlikely. However, you will be making a 4.31%. And if we go ahead and take a look at the dividend history, we can see that it's maintained almost the same. Yes, it's dropped a little, but you're always making around that 3 to 4.2% mark. Now, this is going to be almost the same when taking a look at the Vanguard Total Bond Market Index. It's very similar to the TOT. However, I think it's a little bit less volatile. Since it's less volatile, of course, you're going to get a lower yield at 3.75%. But as well, you can go ahead and take a look at this and see that it's been beating down. And if you were ever to invest in bonds, so you want to have some exposure to bonds in your portfolio, now might be the good time that not only the ETFs are low price, but you're getting a pretty good yield as well. The 5-year growth rate is not great. It's 5.92, but it's definitely not terrible. And you get an annual payout per share of about $2.80. And of course, we have to take a look at the dividend history. You can see some big spikes, but most of the time it's maintained all the way throughout the 20 cents mark. And this isn't something written in stone, you know, but if we take a look at this chart, let me know if you see something before I say it in the video. But every time this ETF reaches around the 25 cents mark, it tends to drop a little bit. So this might drop it. Will it drop the stock price or the ETF price in general? I'm not 100% sure, but we have to wait and see what happens. And now, if you want something that is definitely less volatile than both those ETFs, you can definitely go with something like the SGov. You currently have a yield of 4.36%, which is great for something that barely even moves. Max history of the ETF, we can go ahead and see that this maintains almost the same. However, you're still going to get paid that 4.34 yield, which isn't terrible. This, you can look at it as an actual cash account or like a savings account maybe. Is a 0 to 3 month treasury yield bond, making you a 4.36%, which is barely gonna change in price. Now, if we take a look at the dividends, you have a 5-year growth rate of 184% with an annual payout of $4.38 per share. As you can see in previous years, it has not paid that much in dividends, but now take a look at this, ladies and gentlemen. I mean, this is something you want to look into to just add to your portfolio and just make some income, right? Let's say you want to have 10% of this as your portfolio. You're just making 4.36% of your money in your portfolio. I know it's not a lot, but it lowers your risk, it lowers your volatility, and it gives you the chance or the opportunity to start looking for those value places. That's what you want to do in the stock market. and be a little bit more risk adverse, because you're always going to have this in the back end making some money, because you never know what's going to happen with the market. Now, full transparency, as soon as Vanguard took out that article, I went ahead and bought 15 shares of the Vanguard Total Bond Market ETF. As you can see, my total market value is about $1,116, with my average cost being $74.53. Now, this isn't a huge percentage of my portfolio. It's only 10% of my overall portfolio. I'm very happy with this because I have been investing a lot in the healthcare sector, which is beating down a lot, and I think there's some value there. Will it play out for me? I don't know, but I want to risk it. I think there's definitely good opportunities. And apart from this, I think I'm also going to invest about 5% in SGov, just so I could have some money circulating around in my portfolio, not being invested in stocks, and making me a quote-unquote decent high yield. Now, this fund consists of 51% government bonds, 21% securitized bonds, 25% corporate bonds, there's cash and equivalents, and there's municipal bonds. To be honest, you can go with this or TOT like I explained previously in the video. I don't think there's a huge difference. I like this one. It's a lot safer. I don't really have to be paying much attention to it. It's a total market bond. So what happens. My money is there. I'm still going to be making a return. So hopefully it plays out in the future. Let me know in the comments below which would you pick between TOT and Vanguard Total Market Bond. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you on the next one.